Contract 2. The first concept is contract of indemnity. So, what is contract of indemnity? Section 124 defines contract of indemnity as it is a contract where one party promises another party to cover all the losses that the other party occurs by the conduct of the promiser himself or by any other party. So, it's a contract by which one party promises to save the other from the loss caused to him by the conductor of the promiser himself or by the conduct of any other person. It is called a contract of indemnity. So, what is the scope of contract of indemnity? To what extent the indemnifier should indemnify the losses caused by the to the indemnity holder? See, the person who gives the promise of indemnity is called indemnifier, and to whose benefit the promise is given, he is called indemnity holder. So, what is the scope? The contract of indemnity does not apply if the loss is caused due to fire or perils of the sea. So, it does not apply to it. There is a case, Dugdale versus Lovering. So, in this case, what happens is the plaintiffs supplies trucks. So, this KP and Co. and the defendant claims that the trucks is theirs. So, the plaintiff, what he does is he sends it to defendant, but he asks the defendant to indemnify the losses. If defendant is not owner and the trucks is supplied, suppose the owner is KP and Co. and the defendant is faking it, and so the plaintiff asks defendant to indemnify losses if the trucks is not his. The defendant remains silent to their question, but the plaintiff still supplies trucks to him, defendant, and the defendant is proved not to be his owner. The defendant is proved not to be the owner. The court held that the defendant, the promise of indemnity still holds good, and the defendant will have to cover the losses occurred to the plaintiff because it was an implied promise of indemnity. Rights of indemnity holder. So, what are the rights of an indemnity holder? So, the indemnity holder promise is entitled to recover from the indemnifier all damages which he may be compelled to pay in any suit for matters to which a promise to indemnify implies. So, to whatever the matters, this indemnifier promises to pay the losses. To that extent, the indemnity holder is entitled to take from indemnifier. The second point is all costs he may be compelled to pay in any such suit in bringing or defending it, acting under the scope of indemnifier. So to recover the losses, if he files any suit, the indemnity holder, then all the other costs that occurred while he was in suit, that also has to be paid by the indemnifier, and all sums which he may have paid of any compromise of any suit, not contrary to promisor, prudent for the promisor to make in absence of promisor. So in the absence of indemnifier, if indemnity holder pays anything, then that also has to be given by indemnifier. There's an illustration for it. A contracts to indemnify B against the consequences of any proceedings which C may take against B in respect of a certain sum of 200 rupees. This is a contract of indemnity. So A promises B to indemnify any losses that C may do to B. So this is a contract of indemnity. In contract of indemnity, the limits can also be set. Like for example, I will indemnify you only for 200 rupees. So if the other party occurs loss more than 200 rupees, then you have to pay only 200 rupees itself because you have set the limit. The next concept is contract of guarantee. So what is a contract of guarantee? A contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. So, the contract of indemnity is a bipartite agreement. It is a contract between two persons, but the contract of guarantee is a contract between three persons. So here, the person promises to do the person contracts to complete the promise on behalf of other. A contract of guarantee is a contract to perform the promise. He is going to perform the promise on behalf of others or discharge the liability of a third person in case of his default, or he will discharge the liability of other person. So there are three persons: surety, creditor, and principal. So he is the surety. The person who gives the guarantee is called surety. Creditor, to whom the guarantee is given, the person to whom guarantee is given, he is called creditor. And principal debtor, on behalf of whom the guarantee is given, he is called principal debtor. So surety is the person who is guaranteeing, and creditor is the person to whom guarantee is given, and a principal debtor is the person on behalf of whom guarantee is given. There is a case, Buckman versus Darnell. So in this case, the court held that if A and B went to shop and A purchases something and he go on credit on loan and he asks shopkeeper to get on credit on loan, and B tells the shopkeeper that if A does not pay later, then I will pay. Then this is a contract of guarantee. Essential features of a guarantee. So what are the essential features of a guarantee? The first essential feature of a guarantee is there should be a principal debt. Okay, the contract of guarantee arises only when there is a payment. So there should be a principal debt that has to be paid by the principal debtor. If there is no debt there, then the contract of guarantee does not arises. So there should be something to pay. It is called principal debt. The case is Swan versus Bank of Scotland. In this case, what happens is the principal debtor brings an overdraft in the bank, and the surety promises to and the person guarantees to pay if the overdraft fails. He is a surety. So what happens is the person who took the overdraft pays all the money to the bank, but later it was found that the overdraft itself was illegal, and both bank and principal debtor were sued for it, and they had to pay penalty. The loan was paid, but the government put an penalty on both of them. So the bank, it what it does is it brings a suit against the surety, that he had given the surety and he should pay the penalty. But the court held that there was no principal debt because the surety promised to pay for the loan, and the loan was already paid. The penalty is not his, so there is no principal debt. It was held in this case. The next essential feature of a guarantee is consideration. There should be sufficient consideration for the promise. That is, the creditor should provide some consideration to the principal debtor. If principal debtor is paying, then the creditor should have provided something. He should have done some consideration to the principal debtor. Only then the contract of guarantee arises. There is an illustration. A requests B to sell goods and C promises a guarantee. Okay, A requests B to sell goods to C. A requests B to sell him goods. A is requesting B to sell him goods, and C in between comes and tells B that he will guarantee if A does not pay, then I will pay. Then it's a contract of guarantee. Okay, before they should have consideration. The B is selling him goods, that is consideration, and for that C is providing guarantee. The next illustration is A sells and delivers goods to B. So here the consideration is already done. A has already sold and delivered goods to B. After that, C promises that I will guarantee. Then it will not be considered as guarantee. The consideration should be the contract of guarantee should be given prior to the consideration. So in the first illustration, we saw that A is still requesting B to sell goods. The goods have not been yet sold, and during that period, C guarantees to pay. Then there is sufficient consideration, and it's considered as a contract of guarantee. In the second illustration, A has already sold goods to B, and here C is guaranteeing that I will pay if B does not pay. Then it will not be considered as guarantee because the consideration is already done. It should be done prior to the consideration. The third essential is no misrepresentation or concealment. The creditor should not misrepresent or conceal any material circumstances or material facts. Section 142 says that the creditor should not misrepresent any material circumstances or material fact, and Section 143 says that the creditor should not conceal any material circumstances or material facts to the surety. He should not hide anything from the surety. There's an illustration. A appoints B to collect money. B misconducts. See, A is appointing B to collect money for him, but B has done many misconducts, that he collected the money but did not return it to A. He misconducted. So what happens is A goes to C and asks him to guarantees for B, but he does not say anything about B's misconduct to C. B has not returned him money that he does not mention in front of C, and he says that to take his guarantee. So C takes guarantee. This is not a contract of guarantee because A has hidden a material fact to the C, a material circumstance or material fact which was essential. So the guarantee is invalid. The next is Oral or writing guarantee, it is not necessary that the guarantee should be given in writing. If the guarantee is given in oral, then also it will be considered as a contract of guarantee. The case is PJ Rajappan versus Associate Industries Private Limited. In this, the surety has not signed the paper. His signature was not available in the guarantee has given, but yet the guarantee was considered as valid because he gave a oral guarantee. So the essential features of guarantee are: there should be a principal debt, and there should be a consideration. Creditor should not have been not have the creditor should not disclose, should not hide material circumstances by misrepresentation, or should not conceal any material circumstances. And the next essential is it is not necessary that the guarantee should be given in writing. It can be given in oral also. The next concept is extent of surety's liability. To what extent surety is liable? See, surety's liability is coextensive with the principal debtor. The principal debtor, the surety's liability is coextensive with the principal debtor, and he will have to pay all the losses that principal debtor causes to the creditor. So, surety's liability is coextensive with the principal debtor, and he will have to pay all the losses that a principal debtor causes to the creditor. So, coextensive. What is coextensive? So, coextensive represents the maximum liability of a surety. So it coexists with the principal debtor. It represents the maximum liability of the surety, that how much the surety I will have to pay for the principal debtor to the creditor. So this is an illustration. A guarantees B for bill of C. Okay, A guarantees B for the bill of C. So on the bill, the interest is there. So now A will have to pay bill plus interest to C. So he will not just have to pay the bill, but also if any interest has been occurred, then that will also the surety will have to pay the additional cost. Also he will have to pay. That is what it means by coextensive. The next is surety's right to limit liability. The extent of surety's liability, the surety's right to limit liability. Surety can limit his liability. That is, he can tell that I will incur loss only for 5,000 rupees. Beyond that, I will not take loss. That is, he can set limit. So there is no unlimited limit. He can set a limit also. There's a case, Bank of Bihar Limited versus Damodar Prasad. So A guarantees for loan in bank. So here A guarantees for the person who is taking loan in bank. A person is taking loan from bank, and A guarantees for that person to the bank. If he does not pay, I will pay. And the person fails to pay in the bank. So bank try to sue A. The HC says that the first remedies. So whatever the remedies the bank has against the principal debtor, first the bank should consider that remedies. Like for example, the person who might have kept any building in to the bank or something like that, any papers, that bank should go for remedies first. But later Supreme Court overruled that first remedy. His Supreme Court said that whenever the loss has caused to the principal debtor, surety should first pay all of it. Surety should first pay everything. There are no remedies. The next case is Florence Mabel RG versus State of Kerala. So in this case, what happens is the principal debtor takes loans for the bee culture. He wants to develop a bee culture farm, so he takes loan for bee culture, the principal debtor, and the surety guarantees for his. If he does not pay, I will pay. But what happens is all his bee dies because of a virus. The court held that surety is liable. The next concept is Section 129, continuing guarantee. So what is a continuing guarantee? Continuing guarantee is a series of guarantees. It's a series of transactions. The best example is collecting rent. Okay, when you go to collect a rent and a person like for example say A surety, B will A tells to B. There's an illustration. A tells to B that he should employ C to collect rent on behalf of him. And if C collects rent and does not pay to B, then I will pay. A will pay. A is becoming the surety. A tells to B that B should employ C to collect rent on for B's property, and if C collects rent but does not give it to B, then A will incur the loss and pay it to B. So the now C is going every month to collect rent. So every month there is a contract of guarantee will be formed. Say for first month C goes, I collect rent and gives it to B. Then the contract of guarantee is distinguished. And then for the next month another contract of guarantee arises. Now again C will go collect month and he will give it to B. Then the again the contract of guarantee will distinguished, and the next new guarantee will be arise. Now let's say third month C goes collects rent but did not pay to B. then A will have to pay on behalf of to B on behalf of C, because there is a series of transaction, and the continuing guarantee can should be done only once, and it will hold good for every transaction. There's a case K versus Groves. In this case, the surety tells a creditor that he should give 5 sacks of flour in 1 month to the principal debtor. He should give 5 sacks of flour in 1 month to the principal debtor. And if the principal debtor does not pay the amount, then the surety says that I will pay to him, to the principal debtor. So what the principal debtor does, so what the creditor does is he supplies 5 sacks of flour in 1 month to the principal debtor, but and the principal debtor pays the money to the creditor. But what the creditor is, after giving 5 sacks of flour, he again supplies the one sack of flour to him, and the principal debtor does not pay money. So the creditor is tried to sue the surety. The court held that the surety cannot be sued because the contract of guarantee was holds good only for 5 sacks only, and the creditor did a mistake by providing one more sack, and it was not covered in the contract of guarantee. This is continuing guarantee. So there are a series of transactions in a continuing guarantee, and the guarantee is done only once. The next is discharge of surety from a liability. When will the surety be discharged from his liability? So the surety says that I will pay for principal debtor to the creditor. So when he will be discharged from his liability? When he does not need to pay. Section 130 says that by revocation. So the surety can revoke his guarantee, but the surety cannot revoke his guarantee in a normal guarantee. He can only revoke his guarantee in a continuing guarantee. Say in a continuing guarantee, there are future guarantees. So for the future guarantees, he can cancel. Like for example, we saw the rent case here, that A assures B that he should employ C to collect rent. For the first month, the guarantee will hold good, but he can cancel his guarantee for future months. So that's how he can revoke his guarantee. The next is by the death of the surety. This is also for continuing guarantee. If a surety dies, then all the future guarantees in a continuing guarantee will be automatically be cancelled. But say if by the death of surety there's a normal guarantee and the surety's death happens, then his heirs, his legal heirs, the surety's legal heirs, whatever they inherit from the surety, they should pay from it. The next is by variance. If the creditor varies something in the contract or in the conditions, then also the surety will be discharged from his liability. The creditor or principal debtor both should not do any variance. Then also the surety will be discharged from his liability. The next is release or discharge of principal debtor. So if the creditor himself goes to principal debtor and says that okay, no, you are free, I will not take anything from you. He by promise promises him that you don't need to pay anything, or the creditor does an act or omission through which the principal debtor is discharged, then also the surety will be discharged from his liability. The next is composition, extension of time, and promise not to sue. So the creditor he extends time of the principal debtor. The principal debtor has already passed his time limit, and yet the creditor goes to principal debtor and says that I will extend time, but he does not consult to surety. Then also the surety will be discharged from his liability. And also the creditor tells to the principal debtor the promises that I will not sue you if you don't pay. Then also the surety will be discharged from his liability by impairing surety's remedy. So the surety has a certain remedy over principal debtor, and what creditor does is he impairs those remedies in such a way that there is a solid impairment between surety and the principal debtor. Then also the surety will be discharged from his liability. Rights of surety. So what are the rights of surety? There are three rights, three main rights: right against principal debtor, right against creditor, and right against co-sureties. The first point, right against principal debtor. So, what are the right of surety against the principal debtor? Right of subrogation. See, principal debtor, the creditor has a certain rights over principal debtor. Like, for example, say the principal debtor keeps certain paper or gives his house or property to creditor. So, creditor has the right to take his property. So, the in on if the principal debtor does not pay to creditor, then all the right of the creditor has also passes to the surety. That is called right of subrogation. Now, if a building is kept, if a land is kept in hand of creditor and the principal debtor does not pay, then surety can use that land to pay. So right of subrogation, all the rights that a creditor has over principal debtor passes to the surety. Section 140 says it. So there is the case Lampag Iron Ore Co. RE. In this, there is a liquidation company, and what the does is the surety pays all the the principal debtor causes harm, and the surety pays his amount also. But now the creditor has a certain rights over principal debtor, so all the rights now are passed to surety. The next is right to indemnity. So see, whenever the contract of guarantee is not free, the contract of guarantee is not free. So whenever the surety guarantees to cover the loss of principal debtor, a contract of indemnity arises between principal debtor and the surety. So when the surety pays amount, the principal debtor will have to pay the all the amount back to surety later. So it is not free. If principal debtor causes harm or loss to creditor and surety pays his amount to the creditor, now then also the principal debtor will have to pay all the losses to surety later on. That is right to indemnity. A right to indemnity arises between principal debtor and the surety. The next is right against creditor. So what are surety's right against creditor? Right to securities. So all securities that a creditor has against principal debtor, like for example, the principal debtor keeps a land in hand of creditor, so all that securities will pass to surety. And if a creditor mishandles the security, like for example, land is given to him by a principal debtor to the creditor, and a creditor uses that land and utilizes it and uses it and finishes it or sells it, then the surety will be discharged up to the extent of that land cost liability. So right to security. There's a case state of MP versus Kaluram. In this, what happens is the state promises to sell timber. The state promises to sell timber to a person, and a certain person, state of MP versus Kaluram. So the state sold a lot of felled timber to a person to be paid in 4 installments. So the state sells the felled timber to a person which is to be paid in 4 installments, which was guaranteed by a surety, and the surety guarantees it. If the principal debtor does not pay, then I will pay. The state also stated that if installment defaulted, the state would prohibit a debtor from cutting goods and give it to someone else. So what state says is they will supply timber, but if the principal debtor stop paying, then the state will stop supplying wood, and the surety agrees for it and guarantees for it. But what state does is even the principal debtor does not pay money, they keep selling his the timber, they keep supplying timber, and when the principal debtor did not pay, they tried to sue the surety. The court held that surety was not liable because they broke the contract. The state. The next right is right to share reduction. Say if there are multiple sureties, multiple persons of contract give guarantee for principal debtor, then there is a right to share reduction. They will share their money to pay the sureties. Right to set off. All set offs which principal debtor has against creditor. So all the defenses that the principal debtor has against creditor, like the right to sue or any defense that the principal defense has against creditor, it will pass to surety. Those defenses. The next is right against co-sureties. So who are co-sureties? Co-sureties are multiple guarantors. If there are more than one person who guarantees, if there are more than one sureties, they are called co-sureties. Section 138 says that release of one co-surety does not discharge others. So, for example, the creditor releases one co-surety, he releases one co-surety and brings a suit against other sureties. So, the release of one co-surety does not discharge others. The others will still have to pay. Also, the creditor, if releases one co-surety, that does not mean that co-surety is free. The other co-sureties can still ask him to pay his share. The next is section 146 to 147, right to contribution. So what section 146 says is co-sureties are liable to contribute equally. Say for example, the co-sureties should pay equally. For example, A, B, and C promises to E for 3,000 rupees loss. So the E has caused 3,000 rupees. The principal debtor has caused a loss to E of 3,000 rupees. So now A, B, and C will have to pay 1,000 rupees each as co-sureties. The share will get divided automatically. Section 147 says that liability of co-surety is a bond in different sum. Say A promises to cover the guarantee of 10,000 rupees, and B provides a surety of 20,000 rupees. and C sets a limit of 30,000 rupees, and the principal debtor say he causes a loss of 10,000 rupees to the creditor, then all three of them will have to pay extent of their limitation. Like for example, they will have to pay 10,000, 10,000, 10,000 each. That's all. That concludes the chapter.